Welcome to Understanding Tax Residency and the Right of a State to Tax Individuals, a comprehensive guide. In this series, we will explore the fundamentals of tax residency and how it determines which country has the right to tax individuals. Let's get started with the basics of tax residency. When determining a person's tax obligations, the concept of tax residency is fundamental. In general, if an individual is considered a tax resident in a specific country, let's call it country A, that country has the right to tax the person on their worldwide income. However, the individual can also be taxed by other countries according to the source principle. This means that income generated in a specific country can be taxed in that country, regardless of where the person resides. This situation can lead to double taxation, where income is taxed both in the country of residence and the country where the income originates. To avoid or mitigate double taxation, the country of residence typically offers some form of tax relief, such as tax credits or exemptions. Determining tax residency. Common approaches. There are three basic approaches to determining tax residency. First, time spent in the country. Many countries use a threshold, such as 183 days, to determine if a person is a tax resident. Second, the extent of personal connections. This considers factors like where a person's family lives, their job, and where they maintain a home. Lastly, residence concepts from other legal branches. Some countries rely on legal concepts such as citizenship to establish tax residency. Cases of dual residency and double taxation treaties. In some cases, an individual might be considered a tax resident in more than one country. When this occurs, double taxation treaties, or DTTs, often provide mechanisms to determine in which country the person should be treated as a tax resident. These mechanisms help resolve conflicts and avoid situations where the individual is unfairly taxed twice. The concept of tax residency varies across countries. Differences in definitions and criteria can result in a person being considered a tax resident in more than one country simultaneously. This is especially relevant for individuals with cross-border activities, such as expatriates, global entrepreneurs, or those with properties in multiple countries. The OECD Model Convention on Double Taxation is a critical reference for addressing these conflicts. This model convention is often used as a template in active conventions between particular countries, as you always need to check the specific double taxation treaty. Article 4 of this model convention includes a provision known as the tiebreaker rule, which helps determine a person's tax residency when dual residency occurs. On a lighter note, why did the businessman claim dual residency in two countries? Because he wanted the best of both worlds. Lower taxes in one and a beach house in the other. All right, let's dive into the key provisions from Article 4, which covers the tiebreaker rule. First up, we have the permanent home criterion. The initial step is to determine where the individual has a permanent home. So, if someone has a permanent home in one of the two countries, that country will claim them as a tax resident. Now, if the person happens to have homes in both countries, we then look at where their personal and economic ties are stronger. This is what we call the center of vital interests. In cases where it's not possible to pinpoint the center of vital interests, the focus shifts to where the individual has their habitual abode. Essentially, this means the country where they regularly reside. But what if the person has a habitual abode in both countries? Well, then we consider their nationality. And finally, if nationality doesn't resolve the issue, say the individual is a national of both countries or neither, then the matter is settled through mutual agreement between the countries involved. So there you have it. Those are the key elements of the tiebreaker rule. Real-life example 1. The case of French billionaire Bernard Arnault's residency dispute from 2022 to 2023. Bernard Arnault, the CEO of LVMH and one of the world's richest individuals, was involved in a tax residency dispute when he moved to Belgium. The move raised questions about whether his primary motivation was to benefit from Belgium's more favorable tax regime, particularly in terms of wealth and inheritance tax. France taxes worldwide income for its residents, while Belgium has no wealth tax and offers favorable conditions for high net worth individuals. This case highlights the complexities of determining tax residency when a person has significant economic and social ties to more than one country. Under OECD rules, tax residency would likely be resolved by examining factors like where Arnault's centre of vital interests is located, considering both his personal and business connections. Ultimately, the scrutiny around his move underscores the significance of residency criteria, the potential for dual residency, and the need for clear guidelines in such high-profile cases. The Brexit-driven dual residency issues for British expats in Spain from 2021 to 2023. Post-Brexit, thousands of British citizens living in Spain have faced challenges regarding their tax residency status. Previously, as EU citizens, they enjoyed simplified residency and tax arrangements. However, Brexit has led to a reassessment of their residency status, creating a scenario where some individuals may be regarded as tax residents in both the UK and Spain. For many British expats, determining their tax residency has become a critical issue. Spain uses the 183-day rule and the examination of personal connections, family, property, and economic ties to determine residency. Meanwhile, the UK applies similar rules, which could lead to a conflict where both countries claim residency rights. The tiebreaker provisions under the UK-Spain double taxation agreement have become particularly important, determining whether tax obligations primarily fall in one country or the other based on factors like where the individual's permanent home is or where their vital interests lie. On a lighter note, permanent home confusion. What did the tax resident say when asked where his permanent home was? Whichever country has the best tax treaty this year. The role of nationality in tie-breaking. In the context of tax residency, nationality plays a relatively minor role. It is used only as a fallback when other criteria such as permanent home and habitual abode do not provide a clear answer. In practice, countries rely more on the individual's personal and economic circumstances to determine residency. Conclusion. Understanding tax residency is crucial for individuals and businesses operating across borders. The right to tax based on residency is central to international taxation. With the variation in residency criteria across different jurisdictions, resolving dual residency issues requires careful analysis and often reliance on international agreements like the OECD's Model Convention. By applying the tiebreaker rules, countries can effectively determine the appropriate tax jurisdiction, ensuring a fair and consistent approach to taxing individuals globally.